right, good evening, everyone. Chris Holcomb here, Heritage Financial Advisors. Looking forward to spending a few minutes with you uh, discussing faith-based investing and what that looks like with our firm. Okay, so really proud of this, that we can offer faith-based investing to everyone. So some of you recall, and some of you have been with me long enough to know that we've had a faith-based solution for quite some time. It's called and it's now called our standard option. And because a lot of my clients came through the Dave Ramsey connection, I
muted.
If someone, I hear someone in the background, if you could mute, that would be great. Sorry about that. So that a lot of come from a faith background and would ask me from time to time, hey, what else can we do with faith portfolios? And I really was restricted just based on the fit. Not that we couldn't have put maybe different smaller accounts or larger accounts in the current portfolio, but it really wasn't a good fit, either because of the fees involved or just the appropriateness for, say a large account versus small account. So I pressed Vicus Capital, and to their credit, we came up with three new portfolios that we're going to show here in a moment. And they are really great partners in helping create these. And so you're going to see how we're using faith screen stocks, mutual funds, and exchange traded funds in the mix. So I'm really proud of that. And I appreciate their time, because it's no easy effort to come up with a new investment strategy. There's marketing, there's approvals, there's investment research and all that. So Vicus Capital did a great job. As you know, they manage this, help me with the trading of these accounts, do the quarterly reviews, and so on and so forth, and are a great partner in what we do here. With that said, faith-based investing is really an opportunity to align your investments with your values. If you are living a faith-filled life, and certainly you have, what you believe is, parameters that, how you should live. Could be do's and don'ts. It could be just, scriptural principles. It could be, historic church backgrounds, whatever that is, come in lots of different flavors, if you will. But a lot of people don't realize that they can extend those values into how they invest. And so when I present this idea to different clients, they are frankly surprised that it's even an option. And we're one of the few firms in the area that offers this option. So I'm really proud of that as well. So with that, let's jump into the presentation, and we will learn more about faith-based investing. So first off, what's the philosophy and screening criteria? We're going to look at that, and then we're going to look at how we apply these principles to a diversified investment portfolio, and then also the 4 options that I spoke about in my opening comments. So let's first off define faith-based investing.
I don't know.
So inside the Vicus Capital management and research team, they're utilizing a special software that does this screening for us. It's a patented analytics user-defined software that has the capabilities to do a deep dive on each of these companies to see do they pass the screening. So there's a couple screenings that are included. There's one zero tolerance screening, which we'll show you here in a minute, which says that you cannot, if you participate in any of these activities, you're not allowed in this portfolio. And then there's another screening that's a little more lenient, and it says that you can have up to 5% of your revenue in this area or that one and still be allowed into the portfolio. It doesn't necessarily mean that they are in the portfolio right now. It just means they're allowed to be considered in the mix for being in the portfolio. So here's what that looks like. So in the zero tolerance section, it really summarizes into 3 categories, and the big categories are anything involved with abortion or the manufacturing or marketing of, marketing of abortion, pornography, again, manufacturing of that material and marketing the material, and also gambling. So you can see it breaks it down into more subcategories as well, including abortifacients, which would be abortion pills, and online gambling versus gambling operations, adult software, etc. But again, to summarize it, it's primarily abortion, pornography, and gambling are all screened out. Now, the components of the industries that we do allow up to 5% participation would be companies involved in tobacco or alcohol. To drill down a little bit more, a lot of the mutual fund companies that we work with and exchange traded fund companies that we work with will get more restrictive in their screening. For example, a very popular screen would be alternate lifestyle. So these are the sections we screen for, again, abortion, pornography, and gambling, but they may go further in their screening. So just to let you know that there are some additional screens that might be involved in the funds. For example, Timothy Funds is one of those that I know for sure goes a little bit deeper in that, and that's their strategy. So again, faith-based will allow up to 5% of tobacco and alcohol revenues. Companies would have revenues up to 5%, but zero tolerance for these other areas. So faith-based. Remain true to the commitment to offer diversified portfolios, assimilating conscientious managers across all major asset classes. So that's a definition that we're working with. So it's designed for investors seeking a portfolio incorporating investment opportunities consistent with their fundamental religious values. And this crosses really, I think all faiths believe in these fundamental restrictions in their own life. And so we're just suggesting that you might want to think about carrying them over into how you invest as well. Why would you want to invest or profit from companies that are in those sectors, and yet you yourself wouldn't support those? So that's all we're saying. Is that important to you? And if so, here's a solution. Focusing on well-defined religious values. Why am I? Okay, investment program. I'm going to use my arrows instead of my mouse. I think that'll work better. Okay, 4 distinct areas for 4 programs, each highlighting by their own unique features, and we'll go into those in more detail here shortly. They're reviewed regularly by our investment team, so hopefully if I haven't told you many times already, that Vicus Capital, who runs these strategies for us, does a deep dive quarterly review. So 4 times a year, and what they're looking for is where is there risk that we can avoid or losses that we can try to avoid as well, and where is there growth that we can take advantage of, where is there an opportunity to participate in growth. So they make that decision, rate that review every quarter, and then make decisions based on that. So in return, you will see emails from us from the Vicus team saying that, hey, we made trades. If there's no changes made, then you won't get any emails. But that gives you a lot of confidence that you have your accounts are reviewed 4 times a year, and then you and I sit down. That is, the clients that are on the call, we sit down at least once a year and go over everything as well. So these are professionally managed portfolio choices, range all different types of investors, from the beginning investor to those maybe in the middle of their career investment journey, and those that are potentially near or already in retirement. Good fit for all those. All right, so let's spend a little time here. So 4 strategies: faith-based element strategy. So that's for accounts starting at 2,500. So where that's a good fit is I'll get recommendations from parents, for their kids to get started. So that's a good start for them. If you have, I have clients that have almost strictly pre-tax accounts, so 401ks that are pre-taxes, or IRAs, they roll them over into an account we manage, and they don't have any tax diversification. So we talk about starting a Roth IRA, so that would be a good fit for that option as well. And then the next offering is faith-based standard. So both of these are a mix of mutual funds and exchange traded funds. And what we do is we use mutual funds where it makes sense. Mutual funds, as you know, have a manager or management team. So sometimes a manager we feel like will do better in that asset class, and where we think an index will do better, perform better, at least for the next quarter, that's when we'll use a exchange traded fund. So the starting point for that is the 50,000. Now that is the strategy that was been with us the longest time. So it was just called faith-based, but they changed it to faith-based standard, and now it has a recommended minimum of 50,000. Now the faith-focused strategy, excuse me, core ops, is much more tactical. It's really designed to help prevent downside losses as much as possible. Obviously, we can't control the market, but we can help with that by a weekly review process. So that's what's different about this particular strategy. It does have a weekly review that looks at part of it, and we certainly can avoid some losses and take advantage of some growth a little bit more effectively in that strategy. So again, those of you, my clients, will know that I like to have at least one of the accounts, typically the largest account in the household, in that strategy, because I just like the strategic and tactical nature of that solution. But we never use all, we never put all your accounts in a household there, because sometimes just a buy and hold, which is the other three strategies, is effective too. Sometimes the quarterly review can the weekly review can create changes too frequently. So we like to have both buy and hold and a strategic account in there. Just want to see. Well, one note too about the faith focus. So the faith focused has the least amount of faith funds in the strategy, just because of the tactical nature of it. We just don't have enough faith funds to execute on the strategy. So what I just asked the team, I said, give me as many as you can. And so we decided to change the name to faith focused as opposed to faith based. So just a note there. All right. So let's talk a little bit more about faith-based elements strategy. So again, it's designed for those starting out, still looking for good diversification, still looking for adherence to the Judeo-Christian values. And, again, it's designed for small accounts, $2,500 minimum. The elements is set up to match the investor's risk profile. So we've talked about that before. All that means is, are you, say, an 80-20? Say you're a younger investor, 80-20 would be 80% growth funds, 20% bond funds. Or are you in retirement or near retirement? Then typically I would suggest a 60-40 portfolio, 60% growth funds and 40% bond funds. So it still gives you growth without as much risk. The element strategy is a smaller suite of funds. It's only 7 to 10 funds. What we're trying to do is give you good strategic diversified portfolio without unnecessary fees. So that's why we limit the funds to a small set of funds that we feel like can deliver that and still keep the fees to a minimum. These fund managers are consistently reviewed, so they're screened by the software, the faith-based software, and then obviously when we do the quarterly review, they are screened as well. So what's interesting about, so this is what's unique to the faith-based element strategy, is it has a built-in plan for growth. So let's say my example that someone starts off using elements for a Roth account, a new Roth account, because they hear me talk about tax diversification, how important that is. And say you start off with an account opening at 2,500. But then, my next question or next challenge to you will be, let's consider adding to this account, assuming you are under the income limits. Let's consider adding to this account on a regular basis. And if you don't know, you can add up to $7,500 per year in a Roth account per person. If you're 49 or younger, it's $6,500. So for 50 and above, that's $625 a month. So ideally, a client comes to me, we talk about this, they put in at least $2,500, they put in $625 a month, and really within a few years, they're up to $50,000. So what happens at $50,000 is the strategy or the team automatically moves it from the element strategy to the standard strategy at that 50,000 mark. And now we go up to 17 to 20 funds versus the 7 to 10, I think it was, that we had in the original elements. And what that does is that just gives us more exposure, it gives us more strategies to work with, more opportunities for growth, more opportunities for diversification and protection. So that happens automatically, and that's unique to the elements. No other strategy has that bridge feature to it. So the risk tolerances available in faith-based elements are, as you can see, we have one conservative option, we have 4 in the moderate, and then 4 in the growth options. And you can see how they're color coded. We always have 2% in cash. That's where we draw the fee from. We have actually raised that slightly, 5% more. So right now we're holding 7% in cash, just to help with some risk mitigation. And then depending on the strategy, you'll have fixed income, a portion that would be the light blue, domestic stocks, which is a darker blue, navy, it looks like, and then a sliver of international as well. Faith-based standard is similar. In addition, though, it has some non-traditional bonds. So as I said, we have more funds, we have more asset classes that we can utilize in there with the more funds. So we've added a sliver of non-traditional bonds. So that could be international, that could be multi-sector bonds, that could be junk bonds, it could be mortgage-backed bonds, or bank loan bonds, etc. So there's a couple different options. And again, the whole idea is to give you good diversification, which helps with risk, but also give you plenty of opportunities to grow. And again, this was for 50,000 and above. Okay, so let's talk about core ops. This we want to spend a little bit more time on just because there's a lot more moving pieces. So Vicus Capital introduced this strategy in 2013. It's a combination of a core set of funds and then opportunistic funds, funds that can move into different sectors where we see fit. And it's really the opportunity to, or it's an option to help us manage losses or help prevent losses again and take advantage of growth. So a hybrid strategy, it's a combination of long-term asset allocation, basically buy and hold, and tactical management team, which is the part that's reviewed weekly. And that's really based on technical analysis. So a lot of charting, historical charting with that component of the strategy. It's a core satellite technique. So we are having a core of bonds and stocks and international, and then we overweight where we see some opportunity to grow and to get some excess returns or protection. Everything is faith screened as much as possible. Like I said, this has the least amount of faith funds just because of the strategy. There's not enough in that universe to populate the whole strategy. So I'll show you what I mean here. So the core is, again, what you think of normally, a bucket of stocks and bonds, again, domestic, international, and US. The sector satellite that we're using right now, this is the part that's reviewed weekly, and I really like this strategy, again, for the larger, or one of the larger accounts in a household. Right now we are overweighting 2 sectors. It's probably not a surprise to you: technology and domestic energy. So the satellite sector and core flexion satellite are the part of the strategy that get reviewed every week. The core of bonds and stocks and domestic, international, etc., they are only reviewed quarterly. But this opportunistic sector really helps us, because technology, if you follow the news at all, AI is just taken off. And right now, the technology companies are certainly dominating large US companies as far as revenue and sales. So it certainly makes sense to be in technology. And domestic energy, obviously, as well, we can see we certainly don't enjoy paying the extra gas prices, but at the same time, if we can take advantage of the profits that those guys are making, why not do that? And that's really why we're overweighting there. And in the core flexion, so we're looking at our standard, large US, small US, mid-sized US companies and overweighting there. And where we see the growth is in the S&P 500. We're overweighting that a little bit. We're adding a little bit extra there, and also to the large S&P 100 companies. So the theme here, I think you're hearing it, is large US companies are delivering the return right now, and those are a lot of technology companies, obviously. So we move up and down based on the algorithm, make buy and sell decisions on that. That's not the whole process. That's the contributor to the process. That gives us the ideas. Then we actually have a team, investment team of the professionals inside the office that are knowledgeable about these things and can make a good decision as to whether that we should actually make that recommended change that's been told to us by the algorithm, or whether we should stay, or maybe we do something modified where we only follow part of the algorithm and not the whole thing. So the team helps make those decisions. So really what we're trying to do is just eke out some enhanced performance, but also on the third bullet, protection in a downward trending market. So as much as possible, that's what we're trying to do. It sounds ideal. We do the best we can. A good example, though, in 2022, the first 3 quarters, it was really difficult to protect against all the downside because nothing was really working with the interest rates being hiked so frequently. But in general, in a mild volatile market, it works really well. Okay, so let's break down the core strategy a little bit more. You can see that we have active core in fixed income. So those are bonds. We're still trying to beat the market. We're very interest rate sensitive, trying to make sure that we're picking bonds that aren't as tied to the interest rate. So I gave an example, international, obviously. They're not necessarily going to be tied to our interest rates. Emerging market bonds would be another one. Some tactical bonds that are allowed to move in different sectors on their own will be another one. And we want to diversify across. There'll be some treasury bonds in there from time to time. There'll be corporate bonds in there, bank loans, etc. Moving to the index core, we're primarily using low-cost exchange-traded funds, ETFs, as they're best known. Products, mostly funds. They use the word products because it could have exchange-traded notes in there too, but mostly we use exchange-traded funds. They're designed to track the indexes in a very low-cost manner. Moving to tactical satellites. So these are the ones that I just mentioned. So that was, right now we're using technology and domestic energy. And on the core side, we're using S&P 500 and S&P 100. That's where we're finding the best opportunities in those sectors. So just a couple other slides to help you see how the faith-focused core ops works. If you look at the top graph there, hypothetical security price and versus time, this is a really good picture of what happened in 2008. So in 2008, it's October 7th, 2007 is when the market started its decline. And what this strategy would do would be continue to de-risk the portfolio on the way down. Now we can't manage out all the risk, but as much as possible, we try to de-risk the portfolio on the way down. So you see this hypothetical, sell signal. So once we see that, we're starting to again de-risk the portfolio, and that can happen lots of ways. A couple real simple examples that we would probably shrink our small U.S. company space. We would probably reduce our emerging market space, take those dollars and redeploy them to international in the case of emerging markets, in the case of U.S., more to large U.S. companies. Those are two common, strategies that are used. But the other thing is equally as important is when you make a sell decision, you got to also make a buy decision. And this is where individual investors really get stumped. What's the buy decision? The buy decision is the market's bottom. Clearly, the market has signaled the bottom, and now we want to add back in those aggressive stocks and stock funds that would have pulled us down. That is, we want to reinvest into the small US. We want to reinvest in emerging markets because that'll pull us up very rapidly, get us back up to even, and then help the account grow. So that's the feature of the core ops that I think is very strong. If you look at the chart at the bottom left, very similar. If you're starting out with a hypothetical $100,000 portfolio, and if you didn't do anything, you know, it would take you quite a while to get back up to even if the market went down. Whereas if you have a strategy that helps limit the drawdown, then hopefully you're back up to even to your your previous balance, that is, and you're growing. And obviously there's a difference there that's worth looking at. So a little bit different risk tolerance breakdown for the core ops. You can see they work on multiples of 5, a little bit different than the ones, I'm sorry, multiples of 10, but starting off at 35, 45, etc., and then working their way up. Let's see, we got a question coming in here. Okay, so question, are the fees for core op strategy higher due to the more frequent reviews? And actually they're not. They're not at all. When our team looks at these strategies, they're looking at them all together, right? So they're doing the due diligence when they have this quarterly review at the same time. And between what the models and the algorithms provide and what the team's already been thinking about, it's really a similar decision for all of them, and there's no additional cost. Matter of fact, because the core ops is built with some mutual funds and some exchange traded funds. Exchange traded funds by their nature are lower cost funds. So a lot of times the fees for core ops will be a little bit, internal fees, I would say, a little bit less. Thank you for the question. Okay. All right. So this is the one that I want to camp on a little bit. This is the one I'm probably the most proud of because in the private client, we can get even more nuanced than we can in the other strategies. The other strategies, a little bit more boilerplate. But this one, I really pressed the team and I asked them, I said, hey, I have a lot of clients with larger accounts that they don't want to be in BlackRock funds. They don't want to be in China. Can we deliver on that? And they said, we can. So we went back and forth, kind of negotiating as to what that would look like and how that would work. And this is what we came up with. So in the faith focus, and now if you recall, the number that we like to start off with that account, just to kind of keep you thinking along the same lines, is about 250. So an account of about 250,000 is when this makes the most sense. So there are no dedicated China funds. I can't say there's no China in the account because some of the other funds might have a fund inside of them. So I can't say that it's all China's wiped out, but I can say there are no China funds. That is, so no dedicated or no emerging market funds, for example, that or no China funds in there. But sometimes they get slipped in a very small degree. So I can't say zero, so that's why we say no dedicated China fund. But we try to, as much as possible, to avoid anything to do with China. We do avoid BlackRock funds as much as possible as well. So that would be BlackRock mutual funds, that would be iShares. As a lot of you in the faith community probably know, Larry Fink, who's the CEO of BlackRock, has been very much promoting environmental social governance policies, basically become very aggressive on that, along with Vanguard as well. So this gives you an opportunity to really minimize or avoid, in many cases, any dollars in China for BlackRock funds or iShares ETFs. So really happy that we're able to do that. One of the other things that's in this strategy that's not in the other strategies is stocks. So there'll be anywhere between 6 to 8 different individual stocks, again, faith screened. in addition to mutual funds, in addition to exchange traded funds that are in there to, it does a couple things. It gives us a more growth opportunity, but it also lowers the cost because there are no extra costs built into stocks. So that's the other reason that they're in there. I actually asked them to put in 3 alternatives. So alternative mutual funds or exchange traded funds, which really are designed to zig when the market zags and zag when the market zigs. What I mean by that is when the market's down, they're designed to grow, even if it's slightly. So basically a non-correlated asset class of the market. So the market's going down, you hear on the news, market went down 10%. No, 10% would be too big. 1%, 2%, 100 points, whatever it is they like to tell us. These alternative asset classes will tend to preserve the account or also go up a little bit. So that is 10% of your equity portfolio. So if you have a 60-40 portfolio and there's 60% of that, let's just say hypothetically you have $100,000, when it wouldn't work with that. So let's say $1 million portfolio and you have 60% of equity, so it'd be 600,000. So 10% of that, 60,000 would be in the alternatives, just to help you with that. So it's 60%, it's 10% of the alternative sleeve is what we have in there. And this is really appropriate for IRAs, Roth IRAs, SEP IRAs, taxable accounts. So the other strategies that we looked at are more better fit for IRAs, Roth IRAs, simply because of the tax deferral feature. But with a private client, I can go much further, and I think the next slide will be a better illustration of that. So let me give you a couple examples. So like I said, we get really nuanced with a private client. We still have the basic faith-based overlay, but here's how it can help you. Let's just say you have an account with a lot of capital gains in it. You know, you bought a bunch of Apple or Tesla or, you know, Facebook, whatever, in the beginning. And now you have really big capital gains potential, but you like this faith-based strategy. You just see value in it. You want to align your values with your investment choices. What we can do is move that account over, and over a multiple year period, sell out of the capital gains, high capital gains positions to minimize those gains, and then slowly work you into the faith-based strategy. So it's not a sell all at once and move it into faith-based, because that would be potentially a really big taxable event. So we want to be real sensitive. And then if there's a loss in the portfolio, certainly match it against the loss, but as much as possible, try to help you with that. And you set that budget. So let's just say that, you know, there's $50,000 in capital gains in there, and you're like, hey, Chris, I can take about 10,000 a year because I really like this strategy. I want this to be a part of my investment life. Then we would do is you tell us that number. We agree, yes, that makes sense based on what we're trying to do. And then if they couldn't find a loss to net the stock against, then they would just simply work up to that capital gains budget till eventually we moved everything into the faith-based strategy. So that's I kind of spoke on the second to the last one too. Create a transition strategy, and that's really helpful. The other thing we can do for taxable accounts is we can look at very tax efficient solutions and also municipal bonds. So inside the bond sleeve, we can use municipal bonds funds, which are federal tax free. So that obviously being the bigger tax liability, then the state tax is a big help too. If we can get part of your portfolio into federal tax free funds, municipal bonds, that would be the way to go. And really additional customization as needed. So if you had more, you know, that you wanted to talk about, and the account was over 250, then the faith-based private client would give us the ability to do that. Okay, questions. Hopefully I didn't go through that too fast. Any other questions that we have? We are going to record. This is recorded. We will be sending it out. Carrie will be following up with you just to see if you have any additional questions, if there's anything we could help you with. We do have proposals that we can show you on each of these accounts. So let's say you have an existing account you want to move to faith-based, we can send you a proposal to show you what that's like. If you're not a client of ours and you want to check out some of these solutions through the proposal, we're happy to do that too. No obligation. We certainly want to help you if you have a goal to be more faith-based oriented in your investing. I'm just going to pause for a few more seconds. If you have anything, put it in the Q&A. I'm happy to help with those questions if you have anything else. A lot of you are, I'll just say one more thing. I really appreciate a lot of clients that have decided to be involved in the faith-based strategy. I know it's something new. I've been talking about it, those that I think would make a good fit. And now we're up to, so our business is $60 million that we manage for, let's see, we're about 350 clients right now. And of that, 15 million is in faith-based strategies. So that's from zero, or about 500,000 less than a year ago. So it's really exciting to see how folks are engaging and utilizing the strategy. Okay, Pam, is there somewhere we can go to see past performance of these types of accounts? So there used to be, we used to be able to do that, but the regulators continue to change the rules, and we don't have a way to do that now. We can show you a proposal. I can tell you, I got some past performance numbers. The latest, I think I have through August or July. I'd have to go back and look. They just came out with the new numbers, but we don't have them for every risk tolerance within the strategy. So it's a matter of actually looking up the fund within the strategy and comparing it. But I will say this: they are very competitive with traditional investing. That's how I separate the two. They will lag from time to time just because the faith-based funds don't include most of the technology funds for lots of reasons, but basically those are the more progressive ideological companies. They pride themselves in being progressive on LGBTQ, XYZ, whatever that is, and alternate lifestyle and abortion and etc. So by nature of what they promote and how they describe and set up their company, they're excluded. So there will be times where it will lag a little bit on the traditional, but it is still very competitive. Okay, any other questions? Well, don't have any other questions. Please engage us. Please take Carrie's call when she checks up with you or checks in with you to see how you like the webinar. This is a custom webinar. It's not one of the boilerplates we used before, so we always like to get feedback on that. She will also be sending you an email too if we don't catch you on the phone, because we really do like to get get feedback from everyone. So thank you for your time. Thank you for participating. And with that, we're going to end the session. Have a great evening.